And we are live, folks. Welcome to this week's Tuesday Night Live. Got lots of cool things to talk about today. Today, I'm going to be talking about interest rates, my most passionate topic. I was talking about how the economy works, talking about macroeconomics, talking about the money that's sloshing around in the system. Really excited to do it. So we'll jump in a moment. Just wait for a few of you guys to hop online. And as you hop online, if you can smash up the like, send us a little comment, let me know that you can hear us, see us, and the video is streaming well, and we will get into it. But this one is going to be exciting, right? I've got all my usual newspapers, articles, and whatnot, but this here is facts. This is charts. This is data. This is real data. And we're going to do a deep dive into what's really happening out there in the economy and what we can expect over the course of the next 12 months, 24 months, and as we head into that hyperinflation that I've been so excited and warning you guys of for the last few years. So, yeah, if you guys can hear me loud and clear, leave a little comment, smash up the like, and we will get started. So, I'm sure you can all see and all that. Sometimes we get shadow banned here. Here we go. Cool, awesome, Matt. Hope you're doing well. So I'm going to get into the news articles. There's a few interesting ones out there, just as a bit of the state of the economy, and I'll get into the exciting things. So this one here is from Reuters. This here says the New York Stock Exchange glitch sparks volatility in dozens of stocks. There's just a bit of a fun one. A glitch in the New York Stock Exchange triggered massive swings by the shares of Berkshire Hathaway. So everyone's beloved favourite old man, whatever his name is, that Warren Buffett, Warren Buffett. So apparently there was a technical glitch going back about a week ago, 7 days ago, where the share price dropped like 99.97%. In a part of trading, which is very odd, right? Very odd. We see glitches like this start to occur as volatility hits markets, right? There's little, it's like the Y2K bug. As the Y2K bug hit, people didn't know what was going to happen, but we've got volatility out there. Stress testing comes to mind, but yeah. With it, I'm going to share with you. I'm going to keep these three. These three are really interesting. Today, for those of you that are joining on, I'm going to be talking about interest rate, hyperinflation. What are we going to expect? What is the timing of it? I've been very quiet on the interest rates lately, and I'm going to share all that with you today. So we'll get onto that later. These are three articles that are very important. But anyway, I'm going to go through the rest of these articles first. We talked about this 2 years ago. The zombie corporate apocalypse has arrived. Nothing is okay about the rate of delinquencies in Australia. For years, this column has been warning about the coming zombie corporate apocalypse. Well, we have two here at B.Invested. I've been talking about the zombie companies, what to invest into, what not to invest into, and asking the very important questions that people don't want to ask or people don't even think about asking out there. It goes on to say that it's a collapse of subprime business borrowers as interest rates surged, care of the demand side induced inflation crisis, which remains unresolved. We reportedly warned that Australia could experience the worst default cycle since the 1991 recession, and as one opens a newspaper each day, you read about this playing out before your eyes, and with residential developers, builders, commercial property investors, airlines such as Bonza, entertainment venues such as Public Hospitality Group drop like flies, and it's only going to get much worse as rates stay high. So as we see those rates stay high, we will start seeing more people out of jobs. The system get much worse. I did see, we'll get onto that. I've got another one here in a moment that I'll share with you. This here is an article, I think it was on news.com. Broke 25-year-old Australian business owner reveals vicious cycle. Young Aussie business owner has revealed the vicious cycle is stopping her from making money. Some chick in Byron Bay runs a sustainable clothing label. The brand is very on trend, inspired by 1970s and the kind of prints you see on cool girls wear on TikTok. Still, she's noticed a significant drop in sales since the cost of living crisis took over Australia. I'll keep wondering why sales are so low on my business right now, but then I remember I too am not buying anything. Miss Munro said she's broke and not shopping herself, so she understands why customers aren't buying right now. I'm broke because you guys aren't buying anything. You guys are broke because the economy is fucked, she said. What am I meant to do? That just sums it all up. I don't want to get too much onto these articles today, but I will do because it is very crucial about what we're here to talk about. There's not many articles actually this week. I've only got these couple here. We're not getting into this fella. Whenever I see all these people look at folks like this and are like, oh, he's our Lord and Saviour. We're looking for someone that's coming to save us. And these are all actors that are placed there. They've taken you away from your truth source and truth code, but they put in folks like this and they go, oh, is he going to win? Isn't he going to win? I'm going to make things great again, whatever. I'm not buying into this stuff, right? I don't care who's sitting there. They're all puppets, right? I want to know who the puppet masters are and how they're pulling those strings. So that's what this article's about, though. Inflation data this week could help determine Fed's timetable for rate cuts. So this here is from yesterday. It says Washington, after Federal Reserve officials meet this week, a statement may suggest that they have some meaningful progress in inflation this year, a prelude to eventual interest rate cuts. Yet it's hard to say because the officials themselves may not know for sure until they begin their meeting. That's because the government's latest snapshot of inflation data will be released on Wednesday morning, just before the Fed begins the second day of its policy discussions. One key issue is the sentence the Fed added to its statement after the last key meeting, that there has been a further lack in progress, bringing inflation back to the central bank's 2% target. Inflation becomes blah, blah, blah. I'm going to leave that one to the side. I'm going to show you guys a little video that I saw. I'm just going to play it. It's only the audio that's important. It's a Instagram video here. Instagram Reels. Here we go. So this here is off a Instagram page that I follow, which is pretty cool.
New data has revealed our economy is weak, with fears the nation is a heartbeat away from a recession. That dire forecast comes despite a new warning from the RBA.
Whoops.
Another rate rise could be coming if inflation doesn't fall. GDP results for the March quarter were a dismal 0.1%, the economy barely growing. It means we've seen just 1.1% growth for the past year, the lowest rate outside the pandemic. And we're being told wages are not set to return to pre-pandemic levels until at least next year.
The GFC was 10 out of 10. This is 20 out of 10. This is as tough as I've ever seen it.
I haven't seen any customers for the last 3 months. I've been suffering for the last 3 months. And I thought recession probably started 3 months ago, or probably more.
The vibe of people, don't worry about sales. I'm not even getting a smile some days for 4 or 5 hours.
The RBA governor today conceded the economy was weak, but says the best thing they can do is get inflation down.
But if it turns out, for example, that inflation starts to go up again, or it's much stickier than we think, we're not getting it down, then we won't hesitate to move and raise interest rates again. We'll be driven by the data, and the data will tell us if we need to move.
But the government is...
Interest rates again. We'll be driven by the data.
Be driven by the data. There's that chick that looks like what's the name? Bullock. The lady's name is Bullock. She looks like Caitlyn Jenner. She's given us advice about finances now. Anyway, that's just what you're seeing on the news. I don't watch the news. I saw that come up in a reel and I was like, that's pretty interesting. Looking at all of the things that we talked about going back the last 2 years, 3 years, I want to clear something up actually, just regarding some of the things that I have said in the past. I made a note the other day because what I'm going to share with you, we've seen 3 countries now reduce their interest rates in 2 days. Right? So 3 countries have dropped the interest rates. We're going to go through that. I'm going to talk about what they're talking about there. And I made a post on my Facebook page, and someone commented on the Facebook page saying, Nathan, you said that they will not put interest rates up. Going back for the last few years, you said that they will not put interest rates up. I encourage everyone to go and watch every single one of my videos when I talked about interest rates. It wasn't the word that they won't put them up. I said that they can't put interest rates up. Doesn't mean that they won't, right? So be very careful of the words that are being used. Just like the words coming out of these people's mouth, the words that I say are very, very crucial. I said that they can't put the interest rates up, and if they do, we will see those zombie companies blow up. So here we are, all over the news. They've pushed the interest rates up. They've reversed course of monetary policy. Everything's blowing up, and what is to come after this? And that's where the hyperinflation comes. So with it, let's have a look through some of these. These are just little articles. One of them is a Twitter post here. It says from the ECB, we cut our key interest rates by 25 basis points. Keeping interest rate high for 9 months has helped us push down inflation. It is now appropriate to moderate the degree of monetary policy restriction. Right? So the interest rate has fallen from 4.5 to 4.25% in the Eurozone. So that's what we've seen there. Let's read a little article. This one here is from BBC. They're always such attractive looking women here, eh? And dudes, right? They're always such attractive looking creatures. Eurozone cuts interest rates for the first time in 5 years. The EU has become the second major global economy to cut its lending rate this week, saying that it made progress in tackling inflation. The ECB announced it's cutting its main interest rate from an all-time high of 4% to 3.75. Sorry, I was looking at this one here, not the deposit facility here. So that follows the Canada's decision on Wednesday to cut its official lending rate. I've said the next one, right? The move comes as voters head to the polls for the EU-wide elections over the next 4 days, with the outcome expected to reflect people's happiness of the cost of living pressures. Christine Lagarde, the president of the ECB, said the outlook for inflation had improved markedly, paving the way for the rate cut. However, she warned that inflation was likely to remain above the bank's 2% target well into the next year, averaging 2.5 in 2024 and 2.2 in 2025. So I'm just going to draw here, right? Just bear with me and let's walk through this. So let's say that you had something that was worth $100, right? Let's just say it was something worth $100. And in 2020, we saw a 3% increase, right? So that means it would be $103 at that point, right? Pretty common sense, right? And then let's say in 2021, we saw a 4%. That would mean the 103 goes to about $107.2. So $107.20, just roughly making up these numbers here. And then in 2022, we saw a 5% increase. So 107, let's say $5, $6 on top. That would take us to about $113. In 2023, we saw another, say, 7% inflation. $7, $8 goes in there. So $8 is $121, right, in 2024. And then say it only goes up by 2.5%. It's 2.5 and 120, which would be another, say, $5. So it's $126. I just calculated it off the top of my head, right? So you had $100, which now is $103, which is now $107.02, $113, $121, $126. You feel like, okay, 2.5% is great, but really you've probably just seen a $5 increase, right, or a $3 increase occur. It doesn't mean that we're going to see the price of goods come down tomorrow. It doesn't mean anything like that. It just means that you're going to stop losing your rate of money at the current rate. But at the same time, we're going to see mass deflation across other assets. So really, if you're trading inside of those currencies, there's opportunities to arbitrage and clean up, which is what all these governments are doing with their debt and whatnot. The reality of it is that I don't know what you're looking at, whether it be the food you're stuffing your face with, whether it be the bottle of milk, carton of eggs, the chocolate bar, the car, Whatever it is that you're consuming today, it didn't just go up by 20% in the last few years, right? It's gone up a hell of a lot more than that. So just something to bear in mind as we go through that. So the first country we've seen is the European Central Bank, the ECB. The second one that we saw come down was Sweden's Riksbank. So it goes on to say, Stockholm, the 8th of May, Sweden Central Bank cut its key interest rate to 3.75, down from 4% on Wednesday, as expected, and says it's likely to cut 2 more times in the second half of the year if inflationary pressures remain mild. After a 2-year rate hiking cycle, central banks around the world are weighing in to start an easing policy, but the timing's proven tricky as rate setters, well, I can't read it. The focus now is on how fast rates will come down. We've penciled in a pause for the June meeting, followed by 3 more rate cuts by the end of the year. He said a positive surprise in inflation figures for April and May could put a June cut back on the table. The Riksbank, however, has worried easier policy could undermine the Swedish crown and add inflationary pressures, especially if Sweden gets out of sync with the European Central Bank and the US Federal Reserve. Very important to note that, right? Let's read that comment again. The Riksbank, which is the Swedish central bank, was worried that easier policy could undermine the Swedish crown and add inflationary pressures, especially if Sweden gets out of sync with the ECB and the US Federal Reserve. So if we notice the day after this, we saw the European Central Bank drop their rates, right? The rates all went up globally together. They will most likely come down globally together. This is very, very big news. If you haven't heard it, which probably isn't even on the news, I don't know. I haven't seen it. I don't watch news, but I haven't seen it in, the trashy news that you see here. But yeah, once again, 3 banks have cut the rates by 25 basis points. So that leads us to this article here, which is my last article for today before I start getting into real facts, real data, and what I see happening. So yeah, let's get into it. Canada becomes the first G7 nation to cut interest rates. Canada is much like us, as a jail year here, where we're living in a big prison colony, just like them, just like just turn off my thing. Getting alerts from eBay here, I think. These countries, I was going to say companies under the crown. Bank of Canada says more rate cuts to be gradual, data dependent. Rate cuts to happen if inflation continues to ease. Limits to how much the Bank of Canada could diverge from the Fed. The Bank of Canada trimmed its key policy rate on Wednesday, the first G7 country to do so, in a widely expected move that will ease pressure on highly indebted consumers, but indicated further easing would be gradual, dependent on data. Let's enjoy the moment for a bit. In a press conference announcing the central bank reduced rates from 4.7 to 4.7 from 5%, the first cut in 4 years. So I just find it interesting, right, that we've got 3 central banks. They've all said the same news. All this news is the same that's coming out across all of the countries around the world. We've got here a comment here that says the RBNZ, which is the Reserve Bank of New Zealand, says no cuts until 2025. I remember when the commie Philip Lowe, the Australian Reserve Bank board member, turned around and said that we will not see a rate hike until 2025. And here we are, with the biggest rate hike cycle in history, and we're seeing potential chances of reversal. So what they say plays no mean on my views. I take no bearing on that, and yeah, I'm going to go through facts. Right? I'm going to go through facts. It's funny, I share this and the camera messes around with the light, right? That's what happens when you have fake lighting. Notice how they go into businesses and say for $33, strange figure that they have, $33, they'll change all your lighting and put you in these LED for whatever reason that causes them. So here we are looking at the RBA cash rate. So I want to share with you a few things. I'm going to start drawing. Might just get out a card here and just start drawing, right? So let's go back to, where are we here? 1990s, right? Let's start with this one here, over 7%. This is when everyone said the interest rates went up to like 20% and stuff like that, just after the recession we had to have in 1992. If you notice here, this period here was probably about a 12-month period where it sat at the top. You had it come up pretty steeply, went from 5% to 7%, which 5% minus 7%, probably a 30% increase in the cash rate, right? From the bottom here to the top is about a 30% increase in the cash rate. Yeah. It didn't even double in that period of time. So just one thing to point out. Then we had the Y2K era, which we had the dot-com bubble, which occurred. So in around the end of 1999, we had here, the markets all took off because they had the dot-com boom, and then it peaked, and they couldn't push the interest rates anymore. Then we saw a black swan event, right? And we saw a few buildings collapse, and ledge plane go through the building, and here we are seeing the rates drop. So from the top here was 5% to 6.5%. That's 1% over 5%. That'd be like a 15 to 20% increase in the cash rate at that period of time, right? But did you notice how quickly it fell? It took this long to go up. It was much lower. It was much different over here. Up, sat there, bang, down. And then it went down from a crash, it went lower and lower. Then from the year about 2003, which is where the real last crash occurred in Sydney, for example, we had this period here, which was dragged out over a period of about 5 to 6 years, right? Then we had the GFC occur. The top of the cycle flattened out here, right? It didn't flatten out too much across here. It flattened out, and then sharply it fell down. So if we look at from the top to bottom, we went from 4.5% to 7.5%. So that was about a 50% increase over that 5-year period. And then in 2007, we saw the rates drop from 7.25% here down to 3%. So the interest rates dropped 66% in a period of 5 months, right? Very, very quick collapse that had occurred. And then they tried to increase the interest rates between 2003 and 2009 to about 2011, and then they found a top. And then what did they do? They dropped interest rates because they couldn't, because the money was on life support and currency was on life support. And over a period of a decade, there was either rate cuts or no rate. There was not a rate increase for 10 years, right? 10 years, right? Because the currency went into palliative care. And I'm going to overlay it with other stats and other data, which is real data. This is really what's happening out there. They don't talk about it out there, but it's, if you can go and get this data and overlay it on top of each other, it'll give you indications of where things are to go and what to expect moving forward. So looking at that, in 2020, we saw the rates hit the lowest point, and in 2021, we saw our first rate hike. Now, if you remember that these rates went up by like 3% to 4.5% or 5%, so it went up like 30%, 50%, 50%. That went up, considerably. Here we are with a cash rate of practically zero, right? And it's much lower than where any of these, right? For let's say there's a 5-year period, it wasn't even 1%. We went up 4,000% in a period of 2 years, right? Never before in any of those other charts had it gone up at so aggressive to where we are today. And we can start to see here at the end, which I said to everyone in around June last year, we would see a reversal in monetary policy, which didn't happen, right? Everyone's like, Birch, you said interest rates are going to fall. You're a shit forecaster. You've got no idea what you're talking about. Stick in your lane and start talking about property investing, because that's what you're good at. And these things leave to the experts, like all those commies that you see on TV. Anyway, we had a change in monetary policy in June last year. They can't push those rates up any higher, and it's tapping out. Now we're starting to see all of the countries around the world change policy and direction, right? They all went up together. What do you think? Put it in the comment section. What do you think is about to happen to our rates here? What date? When is it going to happen? Is it going to happen this week, next week, the week after, whatever the case may be, right? But if we look at the data here, right? So it's just annoying when I put this up, but maybe I can turn this off. Give me 2 seconds. Maybe there we go. It's not reflecting to my ring light so much, right? So if we look here at these up and down, the rates never get back to their all-time highs, right? It's very rare that they get back to where they were. If you look at this trend line here, and it was much higher, right, in 1992. I'm just going to draw a line, a rough line. Just draw straight through that. You can see that they make lower lows at each time, right? Each time they go, lower lows, and they never really get back to where they were. When it did go up so far out of the mean, the drop was so far greater, right? Because it was way over. And this is the death of our currency. This here is the collapse of the currency that we're using. Your dollars are losing their value. It means nothing else. So if we've gone so far back over, can you guys complete what would happen? What happens? What generally happens after this, right? It's not fucking rocket science, right? It's not rocket science. So yeah, if you want to take a screenshot or whatever, that's just my little notes from today. Take a screenshot, keep it there, watch the video later, share it with your friends and family. So my target, someone just wrote here, head for 300 basis points drop. I think that I actually do believe that we will head into negative interest rates here. Time will tell, common sense will prevail. We've aligned ourselves to be in a position to go cashless, right? If we had cash and you can go get your cash very easy, there'd be bank runs and stuff like that occurring. If you can't get the cash out and it's stuck in the bank, it means you can only send it from this bank to the next bank and it's trapped in that system, so you can't have a run on those banks. So they just keep manipulating the laws of physics of what we're working with. So if we have a look and overlay the cash rate target, there is the 10-year Australian government bond yield, which I think everyone should be watching out on. And if we have a look sort of to where we are now, we're sitting back down at about 4%. It's gone over. Is it going to fall off a cliff? We can see here 2009, 2007, bang. 2012, bang. For the rest of the decade, bang. After Corona, boom, 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 right? So you need to look at the 10-year bonds around the world. And the spread between them is this chart. These are all from the RBA website. So this here shows that we're about 2 basis points at the highest point here and the lowest point. So in 1994, it went wild. It went like 4% difference, but it swings back to its mean to zero at the same time. So quite often as they adjust the rates, you see it, you know, at the moment it's at 0% because the bond is basically what that is. So as we start seeing the bonds drop, that gives you an indication as to what's happening to the yield. Now I want to run that over some other charts that we've seen here. Look at credit and available funds out there, and this is where I get really excited, right? This is like, am I a dork? Am I a geek? Am I like, I don't know, right? I don't know, right? But I get excited by this stuff. So I printed out lots of these, and I don't know, I think I might have just saved some on my phone and not actually printed them all off. So let's run with this, right? This here is a chart. It's from Trading Economics, and it's a thing called Australia's money supply, M1 money supply. So it's the money which is in circulation that is out there in the system. So it says here, just as today's little notes that it has on the top of the chart, M1 money in Australia decreased to 1.658.07 billion in March. So it's $1.6 trillion. So it's $1,658 billion in March from 1663. So it's down $5 billion, over a period of a month, right? So it doesn't sound like much, but it's down 5%. So if you had $5 billion, sorry. So if you had $100 and you added $5 to it, you would be increasing that. Yeah. If you had $100 and you took it back to $95, you would be losing $5 off there. So one is expansion of your money. You've got it from $100 to $105, and one is decreasing that, which is going from $100 down to $95. So the amount of money that's sloshing around in the system out there, it's not much, right? But it's enough to see all of the system fall apart, right? And it's exactly what I said would happen 5, 6, 7 years ago. And the excitement as to what's to come from this, when I said over the last 4 years that they can't increase interest rates. I never said that they won't, because I don't know what they're going to do. The reason why I said that they can't is because if they do, it's going to have serious repercussions. So if I was to say, I can't drive my car at 300 kilometers an hour, well, I technically could drive my car at 300 k's an hour, depending which car. Some of them, if I'm driving the Suzuki, right, it's not going to get over 110 k's an hour. But let's say technically the car can go to 300 k's an hour. Does it mean that I won't drive it at 300 k's an hour? If I did drive it at 300 k's an hour, I would hit something, right? All the roads around. Tell me what road you could drive at 300 k's an hour, but you could drive a car at 300 k's an hour, right? So if I chose to be so reckless, I technically could, but there's going to be something seriously fucked up that happens at some point. The longer I'm driving, the greater the chance of something blowing up, probably myself. So when we look at the amount of currency that's being printed into the system, and we look at that, I'm just going to draw, just take note of this. You can go and get this chart, Trading Economics, type into Google, Australia's M1 money supply. It's like the 5th one down in Google. It's easy to get this chart. It's just out there, changes daily, and this is real life sort of tracking. So take a look at that chart. Let's zoom in on these numbers, and I'm going to just draw with my trusty card here that I've got, because it's got a nice straight edge. I'm just going to draw a few little things here, right? So from 1976 to about 1990, the recession we had to have, we're at almost nothing in the system, right? So let's just look at this, right? For the whole 200 years of Australia, right, we came and took over this country 200 years ago. It was under the crown of Australia. It wasn't that people didn't live here more than 200 years ago. It wasn't that, certain people came to this place. It's the fact that the system which has been installed was 200 years ago. For that 200 years prior to, say, 1990, which let's call it around 1988 or whatever, the bicentenary of Australia, which was the 200 years of founding of Australia to what it is, we were sitting at $10 billion. Here is zero, right? On this side. We're up to $1.5 trillion, right? It took 200 years to get to $10 billion. Put that, right? I'm going to have a little drink, right? It took 200 years of this country and our system to get to $10 billion floating around the system. And then in 1970, we changed our currency, right? And then we got into different formats of printing currency. And then if we fast forward, let's just go to 1996, right? So let's just go to this point. This is fun, right? I feel like we're walking through a history lesson here, right? We have $300 billion here. We have $0 billion here. 200 years it took us to get to about $10-15 billion. Here we are in 1996, so it's about 5 years, 10 years. It doubled, tripled, right? We're at about $100 billion, right? So let's do the maths on that. It took 200 years to get to, let's just write a little note down here, right? 200 years to get to 15 billion, let's just call it that, right? And then it took 10 years to get to, say, 100 billion, right? In 1996. And that manipulation occurred. It's only a blip. It's a fucking blip in the system. It occurred from the recession we had to have in 1992. And then we had a big boom, and everyone said, oh, look at this. John Howard, the greatest Prime Minister of Australia to ever exist, right? I grew up in the household that loved the Liberal Party, right? So no one shoot me here. And that took us to about 1999, right, which we can see here. We had a massive upswing, right? And then, so that was a period of about 3 years, right? It's about a period of 3 years. We ended up doubling, right, in 3 years, which it took 200 years to get to 15 billion. It took 10 years, 8 years to 10 years to get to 10 times that. Then it doubled that again, right, in a period of 3 to 5 years here in the early 2000s, right, to get us to 300 billion. And then we had a big boom. It took us from 300 to the GFC to about 500, right? So it doubled again in a period of 5 years, right? And then, here we are, 2020, right? 2020, let's go to there. Took from about 2010 to get from 500 billion here to 950 billion, right? 900 billion from 2020. And then over a period of 3 years, the biggest, worst time that we ever experienced, we ended up at about $1.7 billion, trillion, I forgot, right? So that was a period of 3 years. What the fuck caused in 3 years, right, our currency to go up in 3 years, what it took 200 years to go up in that's like every day is going up what it took 200 years, right? When you really think about it, right? And we're sitting here going, it's because you fuckers ate too much avocado and toast. It's because the baby boomers are so greedy, right? It's because, I saw this episode, right? Who remembers that show Dinosaurs, right? I'm the baby, not the mama, right? If you remember that, maybe I'm showing my age, right? There was a series only on, it's called Dinosaurs, and it was like Baby Sinclair. I was watching that the other day. Don't laugh at me. Came on, I was watching it, and there was this thing about throwing off grannies, right? And they once you hit 75 years old, they just throw you off a cliff, right? It was like Earl Sinclair was going to throw his mother-in-law off a cliff because she turned 75 years old, right? I forget where I was going with that. I digress, right? But when we start, I've just drawn the points here, right? I've just drawn the points here. And if we have a look at something, which is just a chart, but I'm just going to straighten it out a little bit, right? The chart has gone up in each economic cycle very clearly here, right? I just drew over the whole chart, right, from each one of those points. That point didn't go up much, and it took a longer period of time. It went up much quicker in a shorter period of time. It went up much quicker in a shorter period of time. Look at these inclines, right? The amount of acceleration, margins rate accelerating, right? They have to print more to keep alive, right? So imagine you have, here we go, you see there's a card here, right? There's a card in my hand. You've got a card, let's call it MasterCard, Visa card, bank card, whatever they call it, right? And you have this FPOS card. There has to be a credit card, right? Let's assume it's a credit card. So here we are, and let's say there's $1,000 on the credit card, right? So we've got $1,000 on the credit card, and just think about this, right? Who printed? Where did this money come from? Where did it come from? Who printed this, right? Because if you and I printed money, we would go to jail because we've created fraud. And, you know, somewhere out there, people are allowed to print money, right? And who do we owe the debt to? Let's just use an example here, right? Let's say they created the first $1,000 ever into existence. And let's call it a credit card, right? They created the $1,000. And we're looking here at the cash rate, because these are really the cash rate that we've got here, right? And let's call it a 1%, 2%, 3%, 4%, whatever the interest rate is, who cares, right? This is the cash rate, right? The cash rate is based on the bond rate, right? Notice they just go hand in hand with each other, right? Hand in hand with each other. So we have the bond rate, and let's just call it 5%, right? For the fun of it. So the first $1,000 got printed to the government, right? And they had to pay 5% interest on it. To who? Story for another day, right? We're not going to get into conspiracy theories, right? But it's not the government, right? The government's the one borrowing the debt. So who's the one that creates the debt? It's a saying that says, I don't care who controls the land, but who controls the money supplies controls the ruler, right? So if you had the first $1,000 and you had to pay 5% per annum as interest, right? Which in the Bible, the Quran, and all other books and scriptures around the world, it's called usury, right? Which is why a lot of people look down upon debt as bad, because usury is bad. Right? Anyway, we're not going to get into religions here either. But if we have a look here, $1,000, 5%, it means after the first year, you'd have to pay $50 back. Right? And let's just use no compounding effect. Let's say you borrowed it for 5 years, right? So you borrow $1,000, you pay 5%, so it's $50. Next year, another $50. Next year, another $50. Next year, another $50. Next year, another $50. $250, right? You've borrowed $1,000 for 5 years, right? Now you have to pay back $250, right? How do you get the $250, right? Well, we need to go and borrow that $50, right? You have to go and borrow the other $250. So now we've got to go, okay, well, we can't pay you that. We're going to default, right? Let's increase the credit card from $1,000 to $5,000, right? Because things are going pretty good here, to $5,000. And let's roll over this debt. So it's $1,000 plus $250, so it's $1,250 they owe us. Let's call it $5,000 now. We've upped your limit. You've got $3,750 to spend. That's 5% per year, right? So now the 5% is on $5,000. So 5% of $5,000 is $250 per year. Now let's assume that we times that by 5 years. That's $1,250 that we'll have to pay in the end of 5 years as interest, right? So that the interest bill now is more than the first 5 years worth of principal and interest, right? And it's rolling this debt over. So your currency was created into existence as debt by the use of bonds, which is determined by your interest rate, which is causing monetary value to go up. So I've said for a decade, right? I remember a mate one day after a Facebook Live, he goes, "It occurs to me now why you said you could pay for your house with a Big Mac. It took 10 years of you yelling at me for me to finally be able to get it." Look at these charts. The credit card just keeps getting bigger and bigger. You need more credit and debt to be in the system to keep it alive, right? So if you notice right up the top here on the point, right? Throughout the last 50 years, right? You don't see dips and falls, right? But here, right at the top, you do. You haven't seen this in 1990, 1995. No dips like this, right? It's like saying you had that credit card. Where are we? Come on, show your face. Here we go. It's like you've had that credit card, and then you're rolling over that $1,000 debt. You owe $250 of interest, $1,250. You roll the $1,250 over. Now you got a 5K loan, which is over here, 5% interest, $250K a year, $1,250 after 5 years. Now it says, well, we're going to cut your credit to like $3,000. You're like, fuck, I can't pay that. Right? It's a shakedown. Right? It's a shakedown. Shaky, shaky, we're coming to collect. And then they go, well, look, maybe we can change something, but we want you to sign up some new terms and agreements, right? Let's add in some little things we can take. Let's take away some of your rights. Let's take away some of let's go and paint them all different rainbow colours. Let's go and do these. These things get installed. Let's take away your plastic straws. Let's take away this. Let's do this. Let's control how we train your kids. Let's take your kids off you, put them into childcare, create a whole new system around that. Put the wife in, so you've got 2 incomes to work from the household. Right? That's the world we're living in, folks. That's the world we're living in. So that's there. I'm going to zoom in, right? I'm going to zoom in. And this here is that same chart that I showed here. That was max over, say, 50 years. And this here is a 5-year, right? And it looks very different. So let's get a little drawing here. And it really amplifies the problem that we have. X marks the spot, right? Here we are in 2020, right? Right? Let's blame it on something, right? That's why I said at the start of what we saw back then that it was all was to cover up the fraud in the system, right? Never knew the extent, but anyway, $970 billion existed, right? In a period of 2 years, they got us up to 1.6 trillion. 1.6 trillion. Couldn't make this shit up, but it's real, right? You're going to work, you're fighting wars, you're selling your soul, you're selling your children, your family, your future. It happens to all of us, right? I'm not trying to hang shit on, I'm not trying to make you feel bad. It happens to all of us, right? We're all trapped in the matrix, but understand this is the lie that's being played to us. It's the rule book that's being, you don't get to see. You go to school and they put the news on and they try and divide people up and they go, this person's fighting with this one. It's because of someone in China. It's because of the person eating a bat. It's because of, you know, from the river to the sea. It's because of whatever, right? They have all these different things that are going on TV, but they don't talk about the currency that's been robbed from you, right? You're going out and you're selling your soul, selling your time, selling time that you can't get back. It's the currency that you have that no one else has, right? And that is where the robbery comes. So how do you participate? How do you take advantage of it? You know, understand that this is the whole game, is that they've set this up for people to benefit from this, right? If we look at this period here, It's the first time that you've ever seen it go back, right? This is called deflation. We're in a deflationary cycle now. And as of about middle of last year, we saw a change in that. I couldn't show you this chart in 2023. 12 months ago, this chart didn't exist because this is data that's coming through from the amount of currency printing that's out there. So we've got deflation occurring, and they're like, fuck, big problem, right? We have to roll these credit cards over, even though they're dog shit wrapped in cat shit. And then we're starting to see a trickle, right? That line there is nothing, right? Compared to these lines here. And those lines there are nothing towards the trend line that we're seeing here, right? What will happen? My expectation is when we look at this in the future, that it will look something like this, right? Straight up, right? It will look straight up. That chart looks like a chart that I've finished off, right? That looks like the chart there, right? And then they'll blame it on your grandma's house. She's hoarded her house. They fought so hard for it, worked 40 years, sacrificed their youth, bought into the scam of currency creation, and they'll blame it on something, and they'll say, we need to take all this and rob from this person to steal from that person and create a war. Anyway, I'm not trying to sound like a negative piece of shit, right? But I'm just drawing what it is, right? So if we overlay all of this data, where do we get to, right? It doesn't just stop there. That was M1. In 2020, 2021, just look at this, right? Look at the extent that it went. They deleted a thing called M2 money supply. There's also M3 money supply here. If we overlay that, we'll look at this from 1966. I'm just going to very quickly draw here. 1966, we're at like $30 billion in the year 2004. So 1966, we're like 30 billion. In 2001 or something, we're at like 600 billion. Now we're at $3 trillion. That chart doesn't stop, right? That hasn't stopped. You can see it's gone woo, right? Woo. Where in this chart does it go backwards? Your money is the worst asset, right? Assets are going up in value because your currency is losing its value. So how can you hedge your bet? Debt becomes irrelevant because I can pay off debt from back here, which seemed like a lot of money, and collect all the asset with a total devalued currency in the future. That's the game I've been playing for 20 years. That's the game my investors play when they get 10, 20, 30, 40, 50 properties. It's all a game. It's understanding how that money works. There ain't no way of changing that. That's a decade, right? You can see that there's like a little break here, a little dip here, and they just keep printing, right? Anyway, so where does that go? What is the growth? Where is it going to? Here's just some credit growth by sector. We're seeing personal growth, personal debt dip. We're seeing business debt increase. It all happened before the GFC. It's all happening now. At the GFC, everything crashed. Right now, everything's starting to crash. That's the expansion of the currency out there, folks. That's the expansion of the currency. If this happened in a recession, let's just look at some key points here and key dates. The recession that we had in the GFC, crash. Crash. GFC. Boom. This one. Crash. Turned off the tap. Or took off right? Turn off the tap, crash. And they didn't really turn the tap off, right? Because they've printed lots of money still, right? They just stopped the tap from coming through, right? It's a credit crunch that we're in. Here we are. Currency, M3. They go hand in hand. This is the currency and this is off the RBA website, right? It's off the RBA website, it's there, right? So if we have a look here, the growth in our currency, it's never been this low. This is over, the whole millennium, right? It's only 25 years or so. But this is from 1999 over here. It's always sat around that 5-ish level, right? And then the system died in 2019. That's how I was able to tell you guys in February 2019 that we would see a rate cut in June 2019. Last week, the 4th of June, was exactly 5 years since our first rate cut, which occurred here, right? The first rate cut occurred in June the 4th, 2019. Go back, look at the history charts. I remember the conversation. I remember the day very, very clearly. It was my mate's birthday, and I was having bets with him. Saying interest rates aren't going to go down. I was like, bro, I tell you, it's going to go down. It's your birthday. It's going to come down. It was like gobsmacked from it, right? But that's when it happened. And look at it now. It's never been this bad, right? It's never been this bad, right? But at the same time, we've never had so much cash in the system. We've never had so much money in the system, right? Why? Because it's all fake. It's all fake. The whole system's fake, right? But that needs to change, right? That needs to change for the system to stay alive. So how do we do that, right? We've got to change policy. What's the policy, you say? It's monetary policy. It's the amount of money that's being printed. It's the cost of the debt. It's getting that debt to people. It's throwing them the credit card. It's throwing the money, say, take some credit. We're going to keep the system alive, right? And when that comes, what happens after that? We'll get into that. So I'm going to just put all this aside. I think I had some little comments here that I was going to talk about for tonight's discussion. So the first one is, what do I expect to happen, right? Do I have a date? I said monetary policy would change by the end of the last financial year, which it did, but you just didn't see a rate cut before then. So when will we see? We will see rate cuts, right? When will we see rate cuts? We'll see a change. They'll be trying to pump everyone, get money, right? Everyone get that. Then they'll blame some guy eating a bat, a solar flare, an alien, some shit we haven't even thought about yet that'll sound funny. The clouds that no one even notices look funny, whatever, right? It'll be something that they'll blame. And we will see the need for them to print money. Last time I was like, I would never have picked, go get this, right? Go put this in there, right? I would never have expected that to be mopping the floor of what they did. But they did. And I said it before they did it, what they were going to do, financial wise, right? I could never have predicted any of the other stuff. I don't profess to. It's fucking evil. When will the rates drop? With the writings on the wall, the writings on the wall, right? It's a timing thing. Will it be today? Will it be tomorrow? Will it be next month? Will it be the month after? Will it be the month after? And reality, right? The reality of it is, if we go back to September, I think it was, in 2007, right? When the interest rates went up over all these years, right, it came down faster than it ever did. It got lower than it ever was previously at its previous low. And still to this day, 20 years later, it never got back, or it's starting to get back there, right? Which is way off trend line, right? So it fell so much. Do I sit here today, right? It's like saying you bought a house. People say, oh, Birch, you're so lucky you bought a house for $120,000 or 150 grand back in 2005 or 2004. I wasn't fucking lucky. I was paying stupid interest rates. The rent for 250K in Sydney was like 150K was like $150 a week. It was stupid, right? The numbers weren't good. It was shit. It was like buying a 200 grand property today, renting for $350 a week, right? If I said the interest rates dropped in September 2007, or they dropped in January 2008, Who gives a fuck, right? It happened. It happened, right? This whole game is rigged. They couldn't drag the rates up because the amount of currency that has been created and fraud and manipulation on our monetary system and on our lives, right, at epic scales that we never thought would or could be possible or would happen in our lives, right? You can't increase it like what they have done, right? It just doesn't math, right? It doesn't math, right? So it doesn't matter which day it's going to fall. It doesn't matter the minute it falls, right? If it means a lot now because it's like, oh, it's so painful, right? Every time there's rate, let me tell you, my rates have gone through the fucking roof, right? Pay more than any of you would pay on interest, right? And oh, Birchie, but you're not me. Well, when they go up, I pay a lot more because I've got extra zeros on it, right? I feel it. But I look at it from the other perspective. What happens when the rates drop? What happens to my rents? What happens to my cash flow? That is going to be the day where I sit here and I'm the happiest fucker alive, right? And I'm there going, guys, look at this, bang, 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 right? So the timeline of it, the writing's on the wall. They did change monetary policy in the middle of last year. The system's got cracks all the way through it. Businesses are dropping faster than see the comments here in the section, pretty funny. Whatever day it's going to happen, whatever day it's going to happen, the whole system's fake. We're on the eve of it. The writing's all over the wall. Businesses are dropping faster than sports stars and celebrities in the news. What could happen? What's happening in the market now? We've seen rents rise. I think that we'll stop seeing the rents rise at the rates that they are, but we'll see property prices rise. I don't have any charts of that, but you're just going to have to take my word for when I tell you that, and you're going to have to do your own research and your own homework to look at historical charts over each city. That when if we look back in 2009 in Sydney, right, they dropped interest rates. Interest rates in Sydney dropped, right? Properties went up overnight, right? The rents didn't. They stopped. The rents were going crazy, right? And then they stopped. If anything, they might have even got a little bit softer, but the prices started to double again, right? So if you've got an asset, we've got prices that are rising in areas which have doubled this year, right? I mean, in capital cities around the country, prices have doubled already in 2024. What's going to happen when you see interest rates drop? Well, you go to the barbecue, be honest to yourself and be honest about the scenario. If you go to a barbecue this next weekend that comes up and you're having a drink or a smoke and chatting to someone, and you say to them, oh, you're looking to buy a property. What do you think of the interest rates? What do you reckon about what's happening in the world? What's happening with blowing people up? Whatever the case may be. Just be like, oh, what would you buy investment property? Would you buy a house to live in? They're going to be like, it's too expensive to buy a property, right? It's too expensive to buy a property. When interest rates come down, I'll go and buy. I'd love to buy a property, but I don't service for it at the moment. How many people here that are watching would want to buy a property, but your bank won't allow you to buy one, right? If you were able to buy one, you would, you would go and buy one, but you're not buying one because you don't service for it. So if interest rates fell, right, and remembering they've gone up from 10 basis points to like 435 basis points, which is 4,250% from a cash rates perspective. If that went back down and the interest rate went from 6.5% down to 3% again, and you could service, how many other people are waiting to go and buy, right? So I think that rents have a little bit further to go. I don't think it'll all happen overnight. We're bringing in a lot of people from migration to help keep this Ponzi scheme alive. I was reading an article beforehand. It was the first article on news.com maybe like an hour ago before I came online. And it said on that news article that there's been 18,000 people per day coming in the country. 18,000 people a day. Just think about 20,000 people. Where did you see 20,000 people last, right? 20,000 people last. Let's say you went to the Easter show. Let's say you went to the football match, right? Let's say that you went to a Taylor Swift concert, right? Don't get me started on satanic rituals, right? But anyway, let's say you went to the Taylor Swift concert. You see all those people being packed into the stadium, right? Drinking the Kool-Aid, whatever. That's what 20,000 people looks like, right? 20,000 people per day. Per day coming through, right? It's crazy. Actually, maybe it's 20,000 per week. I'll have to go and just double check. Let me just double check that. I don't want to get the wrong info because someone will hold it against me in the future. Sorry, 20,000 people a week, 18,000 people a week, right? My bad. Sorry about that. It's per week. Per week, right? That's a shitload, right? The train network can't support that, right? The train network can't support when 20,000 people go to a football game or a concert or whatever the case may be. That's our airports bringing people into our country, right? Bringing people into the country every week, right? Insane. So the Ponzi is going to keep Ponziing. The money creation has to go on. They can't reverse it. When I say that I never said that they wouldn't do this, right? I said that they can't. It's mathematically impossible, and something has to give. And the thing that's giving is our lifestyle, our affordability, our cost of living, our quality of life is disappearing to keep this Ponzi scheme Ponziing. How much longer can it go? Go and have a look throughout history and see what happens throughout time with monetary policies, currencies. The currencies are just a debt-based fiat currency. Fiat means fake financial instrument in order to, manipulate the realms out there, right? It's like the clock is the handcuffs, right, for your soul, because you've got the strap around your arm and you're looking at the clock and you're wound by the clock because things are happening, time floats past us. But it's a measurement which is able to be attached and commoditize your life. So yeah. Let's go through some of the questions for you guys. I hope that you like some of my stats and charts that I've shared with you tonight. My viewers is that we are on the eve. I've said it, I was going to make a whole video on this. So this can be my video if my marketing team's watching. Use this video, share it around, and let's look back at the predictions of what we're talking about today. And maybe in a year's time or 2 years' time, someone could tell me to go and reprint all of these charts again from the RBA chart pack, and we can see what's happening with currency creation and which direction those charts go, right? Because it's obvious, right? My thoughts are rates to come down. When they come down, who knows? But our currency is on its last legs and on its deathbed. It's been in palliative care since about 2008, 2009, as we can see from our lovely charts that we were looking at beforehand. Let's go and get our charts back. That's around when it started to die around here. And that is when we've been put on dialysis. And when we look at overlaying our bonds, they've been dying at the same rate, right? Questions, comments, let's chat. Chris says here, Nath, I think we need to create a social group so we can all catch up on a regular basis across Melbourne and Sydney to G each other up and do some group buys. Thanks, Chris. Look, I I'll try to put out this content as much as I can. If you like this content, just keep letting me know what you'd like me to talk about, and I will keep it coming. If you do watch these videos and you do like some of the wild stuff that I say, there is another channel that I have, which is very wild, right? I don't share it on here. It's a page called Be Decentralized. I'm thinking of putting all my wild stuff over there. So Be Decentralized on Facebook. I put some memes up the other day. I'm going to go a bit gloves off over there with just very controversial topics about the world we live in, so we can keep a lot of investing stuff on these investing pages. There's also the Birch feed. Go check out birchfeed.com. I've got a Telegram channel where I post data and stuff like this in it, which is cool. Where are we looking at here? My eyes are getting sore from looking at the screen too much, the lighting. Joe says, Nathan, your thoughts on Sydney unit prices? Homes are through the roof. Good question. I buy lots of units in Sydney. I think Sydney units are one of the best values that are out there in the markets at the moment, along with lots of other locations that are in the city. You can buy units in Sydney for cheaper than what it costs to build them. If you're buying units cheaper than what it costs to build them, the cost of construction is going up, everything's going up. I do see very good value in there, especially if they're positive cash flow in Sydney. Laura says here, thanks, first time viewer will follow Be Decentralized. Can you post a link with the correct name? Yeah, I'll try and do that here. I'll just, here we go. I just put it in the comment section there, right? So, not the most tech savvy person. Oh, what have we got going on my screen? Not the most tech savvy person nowadays, getting too old for tech. Julianne says, skills priority list for immigration visas from government, yoga teachers, martial arts instructors and dog handlers, those trades invited. Exactly. I saw here there was another comment. Well, good to see you, Laura, and thanks for checking in as well, by the way. Kane says here, hyperinflation is a big topic of yours. Is there something to occur in the next decade? Yes. The reason why we've seen the level of inflation that we're seeing at the moment is due to the fact that they've printed so much money. It's not that things got more expensive, it's that your money buys you less, so you need to pay more for the same thing. So if you correlate the cost of of your real goods and services going up in value, overlap it. I've lost my chart again. I keep not too much paper. Here we go. If we look at the amount of currency that's going in, and then look at when did a Big Mac double in value? Did it double over this time? Did it double over this time? Did it double over this time? You can see that as currency is being created, the cost of your goods keep going up in that period of time. So that's really what's happening. So they're going to print a lot more of this worthless currency, and the cost of everything's going to go up in value. But if you lock your debt in today because you're buying an asset with debt attached to it, your cash flow from your rent will keep being increased with inflation, as well as the cost to build the asset will continue to rise with inflation. So anyone that's trying to build to compete with you will have to pay a lot more to do so. So your asset will get dragged up due to inflation. I will create a Nathan Birch avatar and have him here on the VR screen. Thank you. Paul says we're in the Great Reset. Yes, we are. It's a reset of humanity, but we've been here for a long time, folks. It's just we're in the final stages. So I talk about, I think I originally saw it on a Mike Maloney video, which if you doubled something, right? So if let's say we're at the Olympic Stadium, right? And you drop a drop of water, yeah, and just make one drop. I'm gonna actually drop a little drop of water here, right? There's the drop of water, right? Little drop comes out. It's like, okay, now I've got water all over my desk. I'll put it on the carpet here, right? That's all right. And then every 30 seconds, you get double what the last drop was. So you'd sit at the top of the stadium, right? And you'd just see the drop go down. You wouldn't even see it. And then every 30 seconds it would double. So one drop turns into two drops into four drops into eight drops into 16 drops, 16 drops into 32, 32, 64, 128, 256, 512, so on and so forth, right? 1028. We get to a point we would start to see a few little drops, right? You might see a little pond, a little, puddle in the middle of the stadium. But you wouldn't see anything until you got to the maybe 45 to 50 minute mark, where you would see that there's like a pool of water, and the pool doubles to two pools, and two pools to four, four to eight, and then it would go on. And it'd only been the last 5 minutes that you would see the stadium get to like 10% full, 20% full, 40% full, 80% full, and then you'd be drowned, right? And it's the compounding effect of the currency that's going into the system. We're starting to see the droplets, but we're not seeing the full scale of a currency crashing because we're just not there yet, right? But it's happening at the velocity is creeping up at a much faster rate, and it will continue to do so. Matt said here, building industry is now the lifeline. Also, no young tradies coming through. You don't see any 20-year-old brickies, which will put prices up even more. Or they'll just make it out of some cheap prefabricated stuff, right? But you're right, like it will put a lot more pressure. If I was young again, right, and I was fresh out of school, I'd probably quit school at 16 as quick as I could. I wouldn't even worry about going to year 11 or 12. And I would get an apprenticeship as a brickie, a sparky, a carpenter, or a plumber. And I would take all the money that I could earn in those 5, 6, 7 years and invest that into assets, i.e. properties and whatever else that I might invest into. And I would, I'd be at a point where I'd be 24, 25, retiring again, because that's what I would see the value at out there in the marketplace. What are the questions? Your rat sales gone, you must have hit your goal. You actually did put on a few extra kilos lately, but I'm down like 20 kilos over last year. I'm running out of comments here that I can see. We've got lots of comments and questions tonight, folks, so I'm not going to keep everyone here. What have we got here? The Allen government has officially backed out its housing promise to build 80,000 homes every year. The promise is being tossed aside as an arbitrary target as the Victorians struggle to build homes. Exactly. They just words, promises, think that are out there. Jimmy says, is there a graph that shows currency creation versus house prices in Australia? No, I don't see that, but if you got the currency chart and then overlapped it with house prices, I think you'd see a very similar sort of trend as years and prices have gone on, and then overlap that with bond prices and interest rates and whatnot as well. David says here, is cash sitting in an offset account against IPs due to serviceability losing its value? Well, if you've got access to it, you can use that to, I'm not giving any advice because I don't know how much, what any of your position is, but if you've got cash and you've got the ability to buy anything and the cash is losing its value, then buying anything that's going to go up in such a great rate would be better than having your cash sitting there losing its value, would be my view and take. I think there's actually a fake page cloning your live right now. I don't know what that is. Maybe just let us know. If you've seen it, post a link to it and we can all report it as a fake scammer. I don't go into my page, right? I don't go on my personal page and comment to people. I don't go and say I'm going to sell you Bitcoin or crypto, or I need a loan, or hey, I'm doing a surprise, can you help me get a gift card? I don't do any of that, right? So if anyone's commenting, which is a bit odd, make sure that you're chasing the source back. My Facebook pages have been up for 10 years plus, 15, 20 years, whatever it's been. They haven't been set up, and 2 years ago I was living in Africa and had a different scam, right? I've seen those fake pages, to be mindful of that. I don't go and add everyone. I'm rarely to accept people on my personal Facebook. I don't even see the acceptances and all that. So Regan says here, thoughts on Queensland rental changes. Does it just make it harder for tenants by limiting the tools they can use to win a rental? I think it's a nil event. the new changes. It makes them feel happy and they've got a win and whatever. But it's definitely not changing the fact of the increases that we're seeing. If anything, it might mean that people are less moving out of their properties. So if you look at the velocity of tenants moving from one property to another, if people are forced to stay in longer or they want to stay in longer because they've got longer leases and all that sort of stuff, means that there's less available rentals out there, which puts more pressure into the market, which means that there's better chance of having larger scale rent increases. If they put a rental increase cap on it, which said that you can't go up by more than 5% or 3% or whatever the case may be, that's when you would see me losing my shit and really concerned and finding a different way. I've actually got an idea which I'm not going to even talk about until it would possibly become a reality if they ever tried it. But I've got a way around that as well, and it's making your rental property more of a subscription service and changing the actual laws around it. So doing different types of leaseholds and creating little businesses for you guys where people are doing a service agreement with you rather than renting a property. So there's ways around that. We'll work through that if it ever becomes a reality. So don't want to give any commie government people the ideas of how to hit us in between the legs. So on that note, folks, I'm going to call it a night. I'm going to thank everyone for tuning in, whether you're watching this on Tuesday night or whether you're watching it at another time. If you do want help, need help, want to know more about what we do, want to see what options that you've got to be able to take advantage of the current market that we're in, there's a link in the description. You can book in an appointment for a discovery session with one of my team. You can always call us 1300 367 925, email us at admin@binvested.com.au, and we'll be back in 2 Tuesdays time, every fortnight, doing Facebook Lives, and make sure that you watch us on YouTube, as well as the No BS with Birchie podcast that comes out every Thursday on Apple Play, Google Play, Spotify. It's called No BS with Birchie podcast. We'll catch up soon, folks. Have a great night. Bye for now.